The trade that keeps draining your account often looks responsible while you're making it. It follows your rules closely enough to avoid suspicion. It feels disciplined because it is familiar. Yet somewhere between the entry and the exit, a quiet habit, not the market, begins deciding the outcome. That is what makes it dangerous. You rarely notice it while it is happening, because it wears the mask of experience. Losses are easy to blame on timing, volatility, or a difficult market. Hidden habits are different. They survive profitable weeks, disappear inside losing streaks, and quietly shape nearly every decision you make. They influence where you place your stop, how long you hesitate before entering, whether you reduce size after a loss or increase it after a win. None of those choices seem significant in isolation. Together, they become a pattern that the market recognizes long before you do. The uncomfortable part is that improvement rarely begins with finding a better setup. It begins with discovering which behaviors have become automatic. A trader can spend months refining entries while repeating the same emotional sequence that sabotages every advantage. The chart changes each day, but the response remains the same. If the response never changes, why should the outcome? Watch carefully what happens before you place an order. Notice the thoughts that arrive when price moves without you. Observe what you tell yourself after a small loss. Pay attention to the urge to make the next trade worth it. These moments appear too ordinary to matter, yet they often determine whether you follow your plan or quietly negotiate with it. Every exception you allow today becomes easier to justify tomorrow, and habits built through repetition eventually feel like sound judgment. The market does not punish impatience because it is unfair. It simply rewards consistency and exposes inconsistency. A rushed entry increases the chance of emotional management. Emotional management leads to reactive decisions. Reactive decisions create results that appear random, even when they follow a predictable chain of causes. By the time the loss reaches your account, the mistake has already been developing for several decisions that came before the trade itself. That is why the habits worth examining are not always the obvious ones. Some look like confidence, others resemble caution. A few are even praised because they produce occasional success, but beneath each one is a way of thinking that quietly shapes every position you take, every opportunity you miss, and every lesson you fail to recognize. Before we examine charts, entries, or risk, we need to uncover those hidden patterns, because until you can see them clearly, they will continue making decisions that you believe are your own. A trading plan can be profitable on paper and still lose money in practice, because of what happens in the few seconds between intention and execution. The difference is rarely dramatic. It is often a late entry after price has already moved, a stop placed a little farther away than planned, or a limit order changed into a market order because waiting became uncomfortable. Each decision feels too small to matter. Together, they quietly reshape the trade into something you never tested. Execution is where discipline becomes measurable. Before an order is placed, every possibility still exists. Once the order is filled, every adjustment changes the original conditions of the trade. If your strategy calls for entering at a specific location, that location is part of the edge. Move the entry by a small amount, and you also change the risk, the reward, and the probability of success. The setup may look the same on the chart, but mathematically it is no longer the same trade. This is why inconsistent execution creates confusing results. You may believe you are evaluating a strategy when, in reality, you are evaluating dozens of slight variations of it. One trade begins exactly where your plan intended. The next begins after confirmation that arrives too late. Another starts because you feared missing the move. Then one is skipped entirely because the previous loss still sits in your mind. When you review the outcomes, it appears the market is unpredictable. The deeper problem is that your execution has become unpredictable first. Pay attention to how often you negotiate with your own rules. The negotiation rarely sounds reckless. It usually sounds reasonable. I'll wait for one more candle. I'll give it a little more room. I'll enter with half size now and decide later. Each sentence appears harmless because it is isolated, but execution habits are built through repetition, not through single decisions. Every exception teaches your mind that the plan is flexible whenever the pressure increases. Good execution is not about acting quickly. It is about acting consistently. Sometimes consistency means entering without hesitation because the conditions match your plan exactly. Other times it means doing nothing because one condition is missing. The important point is that the decision follows the process rather than the emotion of the moment. Precision is not speed. Precision is repeating the same process regardless of whether the previous trade was a winner or a loser. One useful observation is to stop judging trades only by profit or loss. Instead, ask a different question. Did I execute this trade exactly as designed? A losing trade executed correctly provides reliable information. A winning trade executed poorly teaches the wrong lesson. If profit becomes your only measure, bad habits can survive for months because they happen to coincide with favorable market movement. The market rewards them temporarily, and that temporary reward makes them harder to remove. Notice where your execution changes most often. Is it during fast markets? After missing a move? After 2 losses in a row? Patterns usually appear around specific conditions, not random moments. Once you identify those conditions, execution becomes something you can observe instead of something you simply hope will improve. That shift matters because consistent execution does more than protect a strategy. It creates trustworthy results. And once your results become trustworthy, another question begins to matter even more. What are those results actually telling you about the quality of your edge? A trading edge is rarely destroyed by one disastrous decision. More often, it disappears through a series of small statistical leaks that seem too minor to deserve attention. A slightly wider stop here, an extra trade there, a winner closed before reaching its planned target. None of these choices appears large enough to explain disappointing results. Yet over time, they reshape the numbers that your strategy depends on. Every trading method is built on a balance between risk and reward, winning and losing, probability and frequency. That balance does not need perfection to work, but it does require consistency. Imagine a strategy that succeeds often enough because its average winner is meaningfully larger than its average loser. Now begin reducing those winners by taking profits earlier than planned. The win rate may remain unchanged, yet the advantage slowly fades because the average gain becomes smaller while the average loss stays the same. The opposite can happen just as quietly. Suppose you allow losing trades a little more room than your original plan intended. One trade may recover. Another may not. The occasional recovery creates the illusion that the adjustment is helping. But every larger loss raises the amount future winners must earn just to restore the account. The arithmetic changes even if your confidence does not. This is why statistics care very little about your intentions. The market records outcomes, not explanations. Whether you widened a stop because you believed the move was temporary or entered an extra position because the setup looked almost identical makes no difference to expectancy. The numbers only reflect what actually happened. Small deviations repeated often enough become permanent features of your performance. Variance makes this even harder to recognize. A habit that weakens your edge may still produce profitable weeks. Randomness can temporarily reward poor statistical decisions, just as it can temporarily punish good ones. That is why judging a habit by a handful of trades is misleading. A coin does not stop being fair because it lands on heads several times in a row. Trading works the same way. Short-term outcomes often hide long-term probabilities. One practical way to think about this is to stop viewing trades as isolated events. Each trade is one observation inside a much larger sample. The question is not whether this decision worked today. The question is whether repeating this decision 100 times would strengthen or weaken the overall results. That shift changes how you evaluate every adjustment. Instead of asking whether a modification feels reasonable, you begin asking whether it improves the statistics that define your edge. You should also pay attention to habits that increase activity without increasing quality. Adding a few extra trades each week may not seem significant, but if those trades have a lower probability of success than your tested setups, they dilute the overall performance. A strong edge can be weakened simply by mixing high-quality decisions with enough average ones. More participation does not automatically produce more opportunity. Sometimes it only produces more exposure. Once you begin seeing your trading through the lens of probability instead of individual outcomes, your focus naturally shifts. You spend less time reacting to single wins or losses and more time protecting the conditions that allow an edge to survive. And that raises another question entirely: whether the market itself is offering the same conditions your strategy was built to exploit, or whether the environment has quietly changed beneath your feet. One of the quietest habits that damages trading is treating every market as though it were the same market. The chart may use the same symbols, the same indicators, and the same time frame, but the behavior underneath can change completely. A method that worked smoothly last week may struggle today, not because it stopped working, but because the environment it depends on is no longer present. Markets move through different conditions for a reason. Sometimes buyers and sellers agree on direction, creating sustained movement with shallow pullbacks. At other times, neither side holds control for long, and price rotates back and forth inside a range. There are also periods when volatility expands rapidly and periods when it contracts until movement becomes scarce. These are not small differences. They change how price responds, how long moves last, and how reliable follow-through becomes. A hidden habit develops when you stop observing these shifts and begin assuming that the next opportunity should behave like the previous one. You continue looking for trend continuation while the market is repeatedly rejecting directional movement, or you keep expecting reversals while strong momentum continues pushing price higher. The setup itself may still appear valid, but its surrounding conditions have changed enough to reduce its probability. This is why the same trading rule can produce very different results across different environments. Imagine buying every breakout without asking whether the market has been rewarding breakouts lately. During strong directional phases, that behavior may perform well because momentum attracts additional participation. During quiet, balanced conditions, the same breakout may fail repeatedly as price returns to the middle of the range. The rule has not changed. The behavior of the market around it has. Instead of asking only, "Is my setup present?" begin asking, "What kind of market is this setup appearing in?" That single observation changes how you interpret the chart. A pullback inside a healthy trend carries a different meaning than a pullback inside a sideways market. A sharp move after low volatility often signals something different from the same move after several days of already expanded activity. Context gives price movement its meaning. You do not need to predict when one condition will become another. Markets rarely announce those transitions clearly. What matters is recognizing the evidence they leave behind. Are directional moves extending or failing quickly? Are breakouts finding commitment or immediate rejection? Is volatility increasing, decreasing, or remaining stable? These observations help you respond to what is actually happening instead of what you expected to happen. There is another subtle trap. Success in one market condition often encourages traders to apply the same approach everywhere. A strategy that performs well during sustained trends can create confidence that survives long after the trend has disappeared. The losses that follow may seem mysterious because the strategy itself has not changed. In reality, the market stopped offering the conditions that gave the strategy its advantage. The goal is not to chase every changing pattern. It is to recognize that your edge exists within certain conditions, not across all conditions equally. The market is not asking whether your method is good or bad. It is constantly revealing whether the current environment supports the strengths of that method. Once you begin separating the quality of your strategy from the quality of the environment, another layer of trading becomes impossible to ignore. The market may present information honestly, yet the decisions you make from that information can still be shaped long before you realize you've made them. You probably think your trading decisions begin when your hand moves toward the buy or sell button. In reality, the decision often starts much earlier. By the time you place an order, your mind has already filtered information, favored one interpretation over another, and quietly narrowed the range of choices you are willing to consider. The execution is only the final step in a process that has been unfolding for minutes, sometimes longer. Every decision begins with attention. Out of everything happening on the chart, you notice certain details and ignore others. That choice is rarely random. If you are expecting a breakout, your attention naturally settles on signs that support continuation. If you are anticipating a reversal, the same chart begins highlighting weakness instead. Price has not changed, but the story you build around it already has. Once that story takes shape, each new piece of information is judged against it. Evidence that agrees with your expectation feels important. Evidence that challenges it is easier to dismiss. This happens so quietly that it feels like objective analysis. In truth, the mind is often protecting its first interpretation rather than testing it. The longer you stay attached to that interpretation, the harder it becomes to recognize that the market may be communicating something different. This is why two traders can study the same chart and arrive at completely different conclusions. The difference is not always experience or intelligence. It is often the path their thinking followed before either of them reached a decision. One trader keeps gathering evidence until the picture becomes clearer. The other begins searching for confirmation the moment an idea appears. Both believe they are reading the market. Only one is still allowing the market to change the conclusion. A useful habit is to pause before committing to a trade and ask yourself a simple questions in: what evidence would convince me that my current view is wrong? If you cannot answer that question honestly, your decision may already be fixed. At that point, you are no longer evaluating information. You are defending an opinion. Markets have little respect for opinions that refuse to adapt. Another layer appears when you separate observation from interpretation. Seeing price break above resistance is an observation. Deciding that the breakout will continue is an interpretation. Those two ideas often become fused together so quickly that they feel identical. Yet keeping them separate creates room for better decisions. Observations describe what the market has done. Interpretations explain what you believe it might do next. Confusing one for the other is where unnecessary certainty begins. This approach also changes how you respond when new information arrives. Instead of asking whether the market agrees with your original idea, you begin asking whether the latest evidence changes the balance of probabilities. The decision remains flexible because it is tied to current information rather than a conclusion formed too early. That flexibility is not indecision. It is a disciplined willingness to let evidence lead. Strong trading decisions rarely come from forcing faster conclusions. They come from improving the quality of the thinking that happens before any conclusion is reached. When you learn to recognize how your own reasoning develops, you give yourself the chance to interrupt weak decisions before they become expensive ones. But even the clearest thinking needs a structure to support it. Without consistent routines outside market hours, good decisions become difficult to repeat when the pressure returns. That is where professional habits begin to separate intention from consistency. The quality of your trading day is usually decided long before the market gives you an opportunity. By the time the first setup appears, your preparation has already determined how clearly you will see it. Traders often search for better decisions during market hours, while overlooking the routines that shape those decisions beforehand. That hidden habit quietly turns every session into a fresh test instead of the continuation of a disciplined process. Professional routines exist to reduce unnecessary variation. Markets already contain enough uncertainty. Your preparation should not add more. When you begin each day differently, review different information, or skip important steps because nothing unusual happened yesterday, you force yourself to make basic decisions repeatedly. Every avoidable decision consumes attention that could have been reserved for reading the market itself. Think about a pilot before takeoff. The checklist is not there because the pilot lacks experience. It exists because experience alone is not reliable enough to replace a repeatable process. Trading demands the same respect for routine. A written plan reviewed before the session, important price levels identified in advance, risk limits confirmed, and potential scenarios considered before the market opens all reduce the need for improvisation later. The same principle applies after the market closes. Many traders finish the day by checking whether they made or lost money. Professionals ask a different question first. What did today's process reveal? A trade journal becomes valuable only when it captures observations that can improve future performance. Recording entries and exits is useful, but recording why decisions were made, what conditions existed, and whether the plan was followed creates information that can actually change future behavior. Consistency also depends on reviewing patterns instead of isolated events. One excellent trading day proves very little. One poor day proves very little as well. What matters is whether the same strengths and weaknesses appear repeatedly across many sessions. Without structured review, recurring problems remain hidden because each day feels separate. A routine connects those days into one continuous record that can be studied objectively. Preparation should also include knowing when not to participate. Before the session begins, define the conditions that deserve your attention and the conditions that do not. This removes countless unnecessary decisions during live trading. Instead of constantly asking whether you should become involved, you compare the current market with standards you established while your thinking was calm. That simple shift protects consistency because the rules were written before uncertainty arrived. Good routines are intentionally simple. The more complicated they become, the easier they are to abandon. A short checklist that is followed every day is more valuable than an elaborate system used only when motivation is high. The goal is not to create more work. The goal is to create fewer avoidable mistakes through repetition that becomes automatic. Over time, professional habits produce something more valuable than efficiency. They produce reliability. You begin trusting your preparation because it no longer depends on mood, confidence, or recent results. The market may change from one session to the next, but your process begins from the same stable foundation every time. That stability becomes especially important after a position is opened, because no matter how carefully a trade is prepared, the decisions that follow the entry often determine whether a good opportunity remains a good trade. A well-planned entry can create the illusion that the difficult part of the trade is over. In reality, the position has only entered its most demanding stage. Once money is at risk, every movement on the chart invites another decision. If those decisions are made differently from one trade to the next, the quality of the original entry becomes less important than the quality of what follows. Trade management is not about reacting to every price movement. It is about managing a position according to conditions that were defined before the trade began. The moment you start inventing new rules, while the trade is active, you are no longer managing the position. You are negotiating with it. That negotiation often happens in small ways that seem reasonable at the time, but gradually reshape the entire outcome. Consider what happens when a trade moves slightly in your favor. The planned target still lies ahead, but the open profit begins to feel valuable simply because it is now real. Closing part or all of the position early may protect that profit, but it also changes the reward your strategy was designed to capture. If this becomes a repeated habit, profitable trades become smaller while losing trades remain unchanged. The balance slowly shifts, even though every early exit felt sensible in the moment. The opposite habit is just as costly. A trade begins moving against you, yet nothing in the market has objectively improved the original idea. Instead of accepting the planned exit, you widen the stop or delay the decision, hoping price will recover. Occasionally it does. That temporary success teaches the wrong lesson. Over time, the losses that do not recover become large enough to erase the gains preserved by the few that did. Another hidden habit appears when traders respond to every fluctuation as though it carries equal meaning. A normal pullback inside a healthy move feels threatening, so they exit too early. A brief rally inside a weakening position feels encouraging, so they hold longer than planned. In both cases, short-term movement receives more attention than the broader structure of the trade. Price is constantly changing, but not every change requires action. Good trade management depends on distinguishing information from noise. Before adjusting a position, ask whether the market has truly provided new evidence or whether it has simply moved. A trade should not be managed because the price is active. It should be managed because the conditions that justified the original plan have materially changed. That distinction prevents unnecessary intervention and allows the trade enough room to develop according to its own logic. It is also useful to recognize that every adjustment creates a new version of the trade. Moving a stop, scaling out, or adding to a position changes the original risk and reward profile. These decisions should not be made casually because they alter the trade you intended to take. If adjustments are part of your method, they should follow predefined conditions rather than momentary impressions. The goal is not to remain passive after entering a trade. The goal is to ensure that every action serves a clear purpose instead of becoming a reaction to temporary uncertainty. Consistent management allows the original edge to unfold without being interrupted by unnecessary changes. Even then, one challenge remains. Some of the most damaging behaviors in trading do not look like mistakes while you are making them. They appear logical, responsible, and even disciplined. That is exactly why they survive long enough to become habits. The most expensive trading mistakes are often the ones that never feel like mistakes. They arrive wrapped in logic, supported by convincing explanations and reinforced by occasional success. Because they appear reasonable, they survive far longer than obvious errors. You do not question them, you defend them. Take the habit of searching for a new strategy after a difficult period. At first glance, it seems responsible. If results are disappointing, improving the method appears to be the sensible response. But constant strategy changes often prevent you from discovering whether the previous approach actually had an edge. Every time you abandon one method too early, you reset the learning process. Instead of refining your understanding, you remain trapped at the beginning of many different systems. The opposite mistake can look equally intelligent. A trader refuses to make any changes because consistency is important. Yet consistency without evaluation becomes stubbornness. Markets evolve, and methods occasionally require thoughtful adjustment. The challenge is knowing the difference between abandoning a sound process too quickly and protecting an ineffective one for too long. Neither extreme is solved by confidence alone. Both require evidence. Another deceptive habit is confusing activity with productivity. A busy trading day creates the impression of effort. More charts are reviewed, more trades are placed, and more decisions are made. Yet activity has no direct relationship with quality. If additional trades do not meet the same standard as your best opportunities, increased participation simply introduces more average decisions into your results. Time spent trading is not automatically time spent trading well. There is also a subtle form of caution that creates its own problems. Some traders continue gathering information long after the market has provided enough evidence to act. More indicators are added. More opinions are considered. More confirmation is required. This feels disciplined because it avoids impulsive action. In reality, excessive analysis often delays decisions until the opportunity has already changed. Careful thinking becomes hesitation disguised as preparation. Pay attention to the explanations you give yourself after these moments. Do they consistently make your actions sound reasonable? That is where hidden mistakes become difficult to detect. The mind naturally builds stories that protect previous decisions. An unnecessary trade becomes experience. A missed opportunity becomes patience. A premature strategy change becomes adapting. Sometimes those explanations are true. Sometimes they simply prevent honest evaluation. One useful practice is to separate the action from the explanation that follows it. First, record exactly what happened. Then ask whether the reason you are giving now existed before the decision was made or only appeared afterward. If the explanation changes with the outcome, it is probably serving your comfort more than your understanding. Reliable improvement depends on evaluating actions as they occurred, not as they are remembered. Over time, you begin noticing that many recurring mistakes share one characteristic. They are not dramatic enough to attract attention, yet they quietly repeat until they define your results. Once they are recognized for what they are, they become easier to interrupt before they become permanent habits. That realization leads to a different challenge altogether. Recognizing mistakes is valuable, but lasting improvement depends on something deeper than recognition. It depends on building a process that allows every experience, good or bad, to become a meaningful step forward rather than another lesson that fades with time. There comes a point when learning more stops producing better trading. New books, new indicators, new strategies, and new market theories continue to accumulate, yet your results remain largely unchanged. It is not because useful knowledge has run out. It is because the next stage of progress depends less on collecting information and more on observing how you apply what you already know. Development begins to accelerate when you stop asking, "What should I learn next?" and start asking, "What keeps happening in my own trading?" That shift changes the purpose of every trading day. Instead of treating each session as another opportunity to prove yourself, you begin treating it as another opportunity to gather reliable information about your own performance. The market provides feedback continuously, but feedback is only valuable when it is interpreted correctly. A winning trade does not automatically confirm a good process. A losing trade does not automatically expose a flaw.